Let's move on to Trepp.
So this is just another, it's very similar article. And actually I want to show this, the graph they have is the exact same topic. They show the different, I'm sorry, it's the graph below this, the spread over the 10-year treasury for different asset types. And just like the chart from MSCI, you see a narrowing. This is, it's a little bit, the visualization is slightly different, but it's the same story.
Yeah.
Spreads are narrowing, and even I would say particularly this quarter, there was a drop. So that a little bit contradicts MSCI's general point, where in this past, the first, second quarter, there's some uncertainty that could be expressed in the market by Q3. If anything, the point of this Trepp article was the quote that that spreads have trended lower, a telltale sign of investor confidence. More recently, multifamily and industrial trade at the tightest spreads. Retail's fallen in a flight to quality. I think that it is an expression of investor confidence. And it's not short-term confidence too. So this is a slightly different scope, I think, that Trepp is describing than MSCI. MSCI is talking about what's happening now, the vibes now versus Q3. Trepp's trend that they're tracking is a trend that was in place since kind of the 2023-ish. This narrowing spread between cap rates and interest rates. So long story short, I think that this recovery is kind of a long time coming, and that's part of the reason why it's like something extra bad would have to happen, at least in my opinion, for valuations to go down this much. Whether it's bad for housing, whether it's bad for CRE, or both, that seems like what would need to happen. I don't think that there's anything in the trends themselves.
Like if the National Guard and the Marines were deployed on a U.S. major city street or anything like that, Matt.
Yeah. Who knows? It's something interesting. That's what.
So Marcus and Millichap did a video. John Chang, another great video that Marcus and Millichap produced. You can check out the whole video. It's not that long, but we cut out a couple screenshots. Talking about just some of the relations, talking about these cap rate trends by class, looking at Class A and Class B and C, and there's a convergence.
Yeah. So we talked about narrowing spreads. This is happening here among specific property types, and they call it. John Chang in the video calls them spreads. I kind of like calling them ranges, but
sort of range of spread.
Whatever you want to call them, there is the
spread of range.
The first is that I really appreciated is as I think a unique contribution. He's not talking about the spreads between the cap rates and interest rates. He's talking about the spreads between like a Class A property right here and the Class B and C property. And he's also talking about regional spreads. So a spread between a secondary city and a primary city, or a tertiary city and a primary city. And then so he ultimately has the ultimate spread is between the lowest class property, like the not quite so nice property in a very small town, and then compare that to the nicest Class A property in the biggest, expensive city. So for multifamily, that spread is 250 basis points. 4.7 is the cap rate for the nicest of the nice, and 7.2 is the cap rate for the not quite nice at all. And that is the smallest spread of all of the property types listed here. Let me go run down here.
Yes, multifamily is relatively tight. I mean, I guess self-storage is kind of a somewhat similar tightness, but multifamily is tight. And it makes sense, again, because the long-term fundamentals make sense, and there's an amount of capital chasing multifamily deals.
Yeah. So for office, it is 290. That's kind of expected. Retail's 260. Industrial's as high as 310 because some buildings are really old and some buildings buildings are just a lot different from each other. Hotels is crazy, 500 basis points, 5% difference. Oh, I guess more than 5% here.
I mean, there's a difference between the St. Regis and
That's what I'm thinking. Yeah, and, you can get really nicer.
Inn.
I'm arguably probably nicer hotels than you can get multifamily. If you're getting creme de la creme, and you can get also really, really, really bad hotels. So
exactly.
I wonder too are you people more likely to build build a hotel in a smaller town than they are to build apartments there?
It depends on. I mean, there's a lot of sub asset classes of hospitality. I mean, you have your roadside, kind of one night, Days Inn, Holiday Inn, stuff like that. But then you have your luxury resorts. And it's not exact apples and oranges, but it kind of is in a
Yeah,
sense.
yeah.
And it makes sense. I mean, you're not going to probably buy a Four Seasons or St. Regis type level property for the same as a cap rate as a very nice and clean Ramada Inn. But also the risk in hospitality typically demands a much higher cap rate compared to some other commercial real estate asset classes because a little bit more correlated to the overall economy, can be a little riskier. I mean, in multifamily, the average stay is about a year. In hospitality, it's like a day or two. So you got a lot of keys to turn, a lot of rooms to turn.
Yeah. Also, so we talked a little bit about the spread between like the quality of it, and I also talked about small town versus large town. I thought that was one of the most interesting things that John Chang talked about in the video was how smaller cities, secondary markets. Now, I would still think that they're pretty big cities, but that spread between the big cities and the medium-sized cities is shrinking and has shrunken significantly since like 2001 to now. And I think that there's a lot of evidence that not just in Marcus and Millichap, and I'm glad that you said right before we recorded, like, oh, here's another thing that really lines up with what John.
Yeah, it lined up with our slate today. I saw this Wes Staten research at John Burns Research and Consulting. I saw this graph on LinkedIn, agency multifamily cap rate premium discount by market, and it's markets sorted by change in premium discount comparing the 2001 to 2019, now to 2024. And some really interesting convergences of, like as you said, Matt, there's some secondary markets trading for a premium relative to some primary market counterparts. And I don't know, Matt, if we can take all the credit, but Indianapolis is trading for cap rates lower than Chicago.
The movement of its spread, right? I think I'm not, but yeah, Indianapolis has progressed in ways Chicago has not, for sure.
According to West State, Indianapolis now trades at a lower cap rate than Chicago, while Austin's cap rates are comparable to those of San Francisco and Los Angeles. Dallas now commands a lower cap rate than both New York and Boston. So again, it used to be that New York and Boston, these markets, like they just traded at like silly cap rates. It wasn't even worth we couldn't even have a conversation about. It's like we're living in two different universes. I think that maybe the risk that some of those cities presented during the pandemic, looking for growth outside of those cities, has led to this reshuffling, and begs the question, like for Indianapolis, cap rates have stayed so low. Part of that is because the upside in the growth is being priced in, and for a city like New York, where it has been kind of underinvested in terms of apartments, and there's regulatory issues. But it's fascinating. It begs the question, do you start looking at some of these primary markets to get some decent yields? Because, again, you think, buying Main on Main in New York City should pay a premium versus buying Main on Main in Indianapolis.
And what John Chang was noting was this process that is represented on this chart by, I think, the light blue squares, which show, and the lower the square means the more that cap rates have compressed. That's what I'm understanding. So the lower the squares is like the better the market is, basically. Right. And Indianapolis changed in a good way. Their prices really increased by 75 basis points. Cap rates compressed by 75 basis points. And my point was, John Chang's point was, people are going into the smaller cities, and I think part of it is just they recognize that the risk is actually probably pretty much the same. If they live and they pay for their apartments just like everyone else, and they're not, tearing them up, and the population is steady and stable, then what's the difference between an Indianapolis and a New York or a San Francisco or Chicago?
Yeah, the risk is the same, but there's also growth. I mean, again, like Dallas is growing. Like New York is not growing. And Dallas is adding apartments. New York is not adding as many apartments. It's all kind of what the net is. Yeah. But same thing, like San Francisco and Austin. San Francisco, people are leaving San Francisco. Austin, a ton of people are moving to Austin. So if you're talking of, cap rate is a function Again, we talk about what cap rates mean, talking about, yield and valuation metrics and, comparing different assets. If it is also a tool to, like a forecasting mechanism also, a lower cap rate indicates that there's perceived future growth.
Yeah.
It doesn't mean that it will happen. It's just that there's that perception. The reason why Austin traded at such low cap rates back in 2021, 2022 is the perception of significant growth. Now, they were correct that there was population growth. It's just what they missed out on, which is the actual metric that moves the needle, is rent growth and net operating income growth, NOI growth, which hasn't taken place. But I think, again, the Midwest, I think we're likely to see, some, again, Columbus is, pretty low. Not as big change between 2019 and 2024. But still, there's been some cap rate compression. Yeah. Same thing even in Philadelphia, Minneapolis, just calling out some of these markets, even Orlando a little bit.
It's almost Chicago. Like an education. Like, that's what I wonder too, is like there's going to be a big jump and a big flow of capital into these things as people just know about it. I think previously there may have been a liquidity premium that you had in bigger markets where you could just trade, but as more people know them, and more people, it's kind of going to maybe flatten out a little bit where the smaller markets just receive the similar attention. It just makes sense to me.
I think that's the big question, and I've spent a lot of time thinking about that, of those kind of capital flows into primary markets versus secondary markets. Yeah. And that the way. Because if institutions decided that some of these primary gateway markets aren't all what we thought that they were, and you hit the nail on the head, it's liquidity. We don't necessarily need X liquidity. The liquidity in a Columbus, Ohio, or in Indianapolis, or Kansas City is sufficient. Yeah. And we can be a little bit more tactical. And we have to take some time to get comfortable with it, but they could make that decision. That decision hasn't been made yet, and they move in groups. Herd mentality. It's going to take one or two to start leading the charge, and then they'll all start piling in. But if that were to take place, you would really see not even a continuing of the confluence of secondary and primary markets, cap rates, but you may even see some secondary markets overtake primary markets, which like that's happening in comparing Indianapolis to Chicago. But what's interesting about Indianapolis and Chicago is again, there's a lot of nuance to this story, but Chicago, because it's been underinvested for so long because of taxes and regulation and a lot of we're not far from Chicago. We would love to invest in Chicago if it wasn't for some of the things we just said. Yeah. It's like we don't invest really in Illinois at all, even though it's geographically in direct proximity to us, and we like to invest close, in proximity. But Chicago has had a lot of interest because rent growth is really high right now. There hasn't been much construction, and they're seeing some population growth in parts of Chicago that they haven't seen in a long time. Yeah. And there will likely be a return of institutional investment in Chicago, especially as a proxy, for Midwest growth. Yeah. But Chicago still has its issues. But the fact that Indy is trading, again, lower cap rates in Chicago is a little fascinating. Yeah.
There is a little bit of a leveling. I think that performance is diverging, like fundamentals for multifamily are going to be are a whole lot different. Yeah. But I think that it just seems like as more people come into the multifamily market, people are going to pick up on these what's really the difference between one city and the other? Does that really matter to the bottom line, or am I just or do I just not know about it yet? And I think that the number of people that don't know about it yet is going to shrink.
Yeah, and I think sometimes it's somewhere in between where maybe they somebody's known about it and they've talked about it. It's like, oh yeah, we've talked about Indy, we talk about KC, we've talked about those markets, but then goes the reasons why they haven't just yet. Yeah, and so it's just which board meeting do they decide? Yeah, let's pencil in an allocation to those markets. Yeah.